This is Jonathan Ebba with UNH Extension. I'm going to give a lecture on crop costing and pricing. This is particularly for greenhouse and nursery crops, but there's information here that's applicable to others. This is really meant to be a second part of a two-part lecture. If you've not seen the lecture recorded for New Farmer School on crop scheduling, I would suggest that you go watch that first. So first, a disclaimer. I'm not a tax lawyer, neither am I an accountant, not even a business professor. This is just one method that we use in the greenhouse industry to keep track of costs and to get a sense of meaningful pricing. So the first thing we need to distinguish are the two different types of costs. So direct costs are those costs that are associated directly with the crop. So if I pick up a potted geranium, and we'll be using a potted geranium as an example throughout this lecture. If I pick up that potted geranium, there's a pot there, there's a potting mix, there's the cutting. Maybe I'm including the labor. Maybe I can determine how much fertilizer goes there. Maybe I can determine how much heat goes there. But typically, and we'll make that call based on what you think you can accurately allocate to that crop. But it's typically pot, medium, and cutting. And often if we do a incorporated fertilizer, like a controlled release Osmocote, we will make that a direct cost. But if we're injecting fertilizer through the entire system, often that becomes an indirect cost for the sake of this method. Our indirect costs are the ones that aren't directly related to the pot that we're going to sell, right? So these are things like property tax, insurance, maintenance costs, labor, fertilizer, and heat. Some folks will take some direct labor, so the sticking associated with a particular crop becomes a direct cost. If there's a crop that needs a pinch, maybe that pinching labor will become a direct cost. And then all the other labor that doesn't get accounted in that then would be an indirect cost. So direct costs, it's easy to understand how that affects our sale price, right? So if I'm selling a geranium for $3 and my pot costs 10 cents, my soil costs 4 cents, and the cutting costs 89 cents, we know that I need to subtract those direct costs, and I get sort of this gross profit of $1.97 in this example, right? So that one's easy. We know how to deal with those direct costs, but of course that isn't the whole story. So net profit is what really matters at the end of the day, or actually at the end of the year, right? And if we could know before we started growing how to estimate the indirect costs of each plant, we'd have a better handle on how much we needed to charge for that plant, and we'd be pricing more appropriately, right? So the question really becomes, once I've taken away the direct costs, how do I take away the indirect costs? How do I know how much of that geranium, how much of my gas bill goes to that geranium, how much of my mortgage goes to that geranium, how much of my insurance goes to that geranium? How do we allocate those indirect costs to the lowly geranium? And the way we do it in the industry is we invent a unit called square foot weeks, right? Please do not say square feet per week, because that's not what we're saying here. This is square foot weeks, and I'll explain that shortly, right? So we know that space and time are money in the greenhouse business. And so when we're figuring out how much of those indirect costs to put into each crop, we have to take space and time into account, right? It doesn't make sense if I grow a 3-inch marigold that's on the bench for 4 weeks, and I grow a 12-inch enormous hibiscus that's on the bench for 24 weeks, I can't say that each of those pots has the same amount of insurance in it, has the same amount of mortgage, has the same amount of propane in there, right? And so I need to find a way to allocate more of those expenses to the things that take more space and or more time, right? And so what we do is we define the square foot week. It's simply 1 week by 1 square foot. So it's 1 square foot week. So if this pot here took up 1 square foot and I had it on the bench for 2 weeks, I would say this pot took up 2 square foot weeks. And then what we do is figure out how much a square foot week costs my greenhouse range, right? This number is going to be different for every one of us, and it's going to be different from year to year as well. But I figure out how many square feet are in production on week 1, on week 2, on week 3, on week 4 of the year, and I add all of those up for the year, and that gives me the total amount of square foot weeks for the year. And we'll do one in a minute to make this a little more clear. Then I can take all those indirect costs divided by from my greenhouse range, how many square foot weeks do I have total? And that's going to yield the indirect costs per square foot week. I'm sorry, this word should have been over here. So what's the indirect cost per square foot week? So what this might look like, I'm going to do all the weeks of the year, and we see for week 1 and 2, I have no square feet in production, right? Beginning of January, nothing's going on there. And let's say it isn't until weeks 12, 13, and 14 of the year. Now I've got 10,000 square feet in production. And then on the next 3 weeks, I expand that, I bring in more. And so now I've got 15,000 square feet on each of those weeks. Week 18 and 19 is that. And then week 20, I'm to 0. And then I have 0 from week 20 all the way to the end of the year. That's, this is an oversimplification. Of course, this is not feasible for a real greenhouse to be open for so short a period of time, but we'll pretend for simplicity's sake. So now I add all of those up, add all those square feet in production, and I get 115,000 square foot weeks for my range. So my greenhouse range has 115,000 square foot weeks. And when you do this on a reasonable range, you're going to get a number maybe in the millions. You might have some million square foot weeks for the year, and that's okay. Because what we do next is we add up all of our indirect costs for the whole year. And in this example, we've got this particular greenhouse range. Your list will be longer, your numbers will be different, but we'll say that there's $25,000 of total annual indirect costs that I want to allocate to my greenhouse crop. So now I take those indirect costs for the whole year, divide it by square foot weeks for the whole year, and now I know how much to charge per square foot week on a crop, right? And it's this. So when it comes time for me to figure out how much each of these crops cost, and I know that any given crop has a certain number of square foot weeks, I will allocate $0.217 for each of those square foot weeks. So our sample geranium, it takes up, this is going back to the previous lecture on crop scheduling, it takes up 0.44 square feet on the bench. In our crop scheduling, we already figured this out, right? So we already have this in our record keeping. We know that that geranium has 8 weeks of production time. That was an important part in getting our scheduling. So go back and watch that lecture if you haven't. So 8 times 0.44 is simply 3.52. So that one geranium pot uses 3.52 square weeks over its entire life. We said on the last slide that my greenhouse range costs 21.7 cents or $0.217 per square foot week. So that geranium costs 3.52 times 0.217 or 76 cents. So the indirect costs associated with that geranium are 76 cents, 76.4 cents. So now we take that geranium, our direct costs, we already added up pot media cutting, were $1.97. Our indirect costs we just calculated based on square foot weeks, and we end up with our total cost per pot. So what does that tell us about profitability, right? So now we're kind of getting closer to knowing something about sale price and knowing something about profitability. So if we look at this, our net profit are our net sales minus the direct costs and the indirect costs, which looks complicated, but very simply, how much money we made is how many ka-chings came through the register minus the direct costs and minus the indirect costs. So if we look at on that geranium we were just looking at, if we say we have $5 in net sales, if someone's alarm is going off, that's okay. This is a little bit of a trick. I'm gonna fix it in a minute. If we say we have $5 of net sales, and that geranium, so we're selling the geranium for $5. The geranium cost us $1.97 in pot soil cutting, and our indirect costs cost us 76 cents. Then we would assume that the net profit is $2.27. But what assumption did we just make? Right, we made the assumption that I'm selling every one of those geraniums, right? We're making the assumption that every geranium that I grow gets to sale. And that's not a fair assumption, right? We know that we have some shrink. And so we need to account for our shrink in here, right? Shrink is the amount that we don't sell because, well, we'll talk about it. So shrink is our net sales after our shrink. It's what we didn't sell, maybe because we needed to have a certain amount of inventory just to have bench appeal to our customers. That's the good kind of shrink. The bad kind of shrink is it got stolen, or we dried it out, or our employees pinched them too late and we missed the market, or conditions were wrong, or we had whitefly. I mean, there are a lot of bad reasons for shrink. The temptation is to aim for 0% shrink. Why is 0% shrink bad? Right, 0% shrink, typically what that means at retail, it's a little different for wholesale, but at retail that means that your customers came in and bought absolutely every last one of these geraniums off the bench. The implication there is that we lost money. It sounds counterintuitive, but the implication is we lost money because we weren't charging enough, right? And we can imagine that if we grow 100 of these geraniums, if we only sell 95 of them at $3, that's better than selling 100 of them at $2.50. Right, so experts have suggested that at retail, a reasonable amount of shrink to maximize profits might be 5%. Right, so we want to eliminate shrink because we dried stuff out, or eliminate shrink because we got our timing wrong. But we understand at retail there's going to be some level of shrink, and that helps us to know how our pricing is scoring out. So for our geranium, if we anticipate 7% shrink, right? So our $5 retail price minus the 7% of those geraniums that we aren't actually going to sell. Of course, this is worked out over the whole crop, but that works out to be $4.65 per pot on net sales. Right, so that's important. So going back to this now, we see our net sales instead of being 5 are actually $4.65. And that gives us that net profit of $1.92. So shrink changed that net profit. It was 2 something in the previous slide. So how do we anticipate shrink numbers, right? So if we're doing this ahead of time before we even grow the crop, so we can get a sense of profitability and price, we can anticipate shrink, one, by simply aiming for that 5%. We can look at we should be keeping our within our past production records, we should be recording how many don't sell, how many are shrunk because of growing issues, etc. And we can use, the longer we're in business keeping good records, we can use more and more realistic numbers to anticipate that shrink. But I would encourage you to plan 5 to 8% just in terms of your planning on that first crop that you're growing. So now we move to this next concept of net profit margin. This is a percentage. This is going to show us how much profit can be extracted from our total sales. And so this is just a percent number that we're going to use as a target, and it helps us to analyze how we're doing. You know, if we're selling a whole bunch of crop for a whole bunch of money, but it's costing us a little bit more to make than we're actually, it's costing us more to grow than we're actually making, then of course we know we're losing money and we have a negative margin. So we look at this by taking our net profit and dividing it by our net sales. So in our example, our net profit, we just figured on the last slide, was $1.92. Our net sales, remember net sales, this is after shrink, so even though we're charging $5 a pot for this particular pot, we have to account for the fact that there will be some loss to that crop. And that gives us a 41% net profit margin. And if you're doing geraniums at 41% net profit margin, you're in good shape. This is where we want to see you. All right, so what are some of these margins look like, right? So in the greenhouse industry, these were some tough years for us. Back 2008 to 2012, the industry was very mature and profits were shrinking. People were getting tighter, the supply chain was being diversified, and we saw these amazingly low numbers coming out on some benchmarking, right? So these low net profit margins. So people were pulling in lots of money, but they were putting out lots of money and weren't getting a very high margin. Just for fun, I made this slide a little while ago, but I put in the average, national average for the United States about 5 years ago was 7.3. Apple was 24.2. Monsanto was a negative. Monsanto was bleeding money back then. Tax accountants tend to be around 20%. Here's the interesting one for me. Walmart was 3.12 margin. So we had greenhouse industry here, median profitability during these lean years, making half a net margin of what Walmart made. And Walmart, of course, what they do really well is run on these razor thin margins at a high rate of efficiency. So what does that mean for us, right? So at the time, folks in the industry were saying we should be targeting, at least 5, 6, 7, 8% net profit margin when we're doing our planning. And if we're planning crops coming in less than that, we need to change something before we even bring that crop to market, before we even plant that crop, right? Which brings us to pricing. So armed with that information that we have, we can actually, while we're in the planning stage, get a guess at how much net profit margin we would expect to see on every single one of our crops, right? So I'll show you in a minute, but as we run down our schedule, we can do that. And if we're good with Excel does it for us a lot quicker than we do. We can get an estimate on how much we think that net profit margin might actually be. And then we can see, all right, what's the real profitability of this hibiscus versus this huge hibiscus versus this small marigold, and we can adjust our prices if need be. All right, so how do we price, right? So unfortunately, a lot of people price based on their competition. They go down the street, what is that guy charging or that woman charging for a mum? I'll charge 5 cents less, right? And that's a good way to lose money growing a crop. That's a good way to drive kind of the whole industry down, but we also understand that we do have competition. Competition is real, and it helps to create lower prices for the consumer. Another one is people will simply often mark up. So in a production case, they might be taking their direct costs only and doing a markup. Say, I'll take all my direct costs for this geranium and I'll multiply it by 2. And at the end of the year, I'll find out if that covered my indirect costs or not. What I would propose, and since we have these data anyway, and we're building out our production schedules, we should be targeting a net profit percentage there, right? So when we run out your whole schedule for the year, as you calculate for each of those items that net profit, and you can actually get Excel again if you're comfy with Excel, you can say, dear Excel, what price do I need to charge in order to get a 5.25% net profit, right? That's through a function called goal-seek. And then we can see, oh, actually, that's the price that I could sustain on a theoretical basis. Right, so this one's, I'm sorry this is so small, but I wanted to fit everything on here. So this is how this works kind of into our schedule. So we look this right here, this, let me get a different color highlighter. So this 21.7 cents, we already established for my greenhouse range for the year, this is how much the indirect costs me per square foot week. Right, so here's our crop, our geranium. So this geranium, sambar, we're doing it by liner. Our target week, finishing weeks, transplant week, plug weeks, and sow week, this is all the last lecture, right? So we already built this last time we talked about this stuff. We of course want to know how many we're growing, and then I need to know the space per pot, right? Maybe this is linked to the pot size. You'll probably put a column in here for pot size so your employees know what size they're transplanting into. And so this is a function of that pot size and the spacing I want to give it. Now, square foot weeks, where did this number come from? Right? Square foot weeks is how many square feet per pot times how many weeks it takes to do it. And I already have that information from the scheduling seminar. So 8 times 0.44 is 3.52. So this geranium takes 3.52 square foot weeks. Direct costs I plug in. This is pot cutting and medium. Now my indirect costs, this number here, how did I get this? This is how many square foot weeks this crop exists for times my indirect cost per square foot week. Right? So this is automatically generated. I don't have to do this math. Shrink, I'm going to guess, is at 7%. Sale price, I just plug this in. What do I think makes sense? Right? $5 we'll start with saying. And then my net sale per pot, this is accounting for the shrink. Now that doesn't mean that this particular pot is only going to sell for $4.65, but it means that if I grow 100 of these, I'm only going to sell 93 of them. And so 93 of them being sold at $5 a piece works out to be $4.65 per pot of the ones I produced. Right? That gives me a net profit per pot. So this is my net sale minus my indirect cost minus my direct costs, with then a net profit margin, which, you know, we've already looked at these numbers in other slides. This net profit margin is my net profit divided by my net sales, and it's 41%, 41.2%. So you can imagine as you build your crop line after line after line after line after line to create the schedule, it's very simple to calculate these down through as well. And really what we're doing now over here is we're making us be honest about our sale price, what we think is reasonable there, and we're accounting for both of these types of costs. And it gives us this one little bit over here where we can look at and say, is that reasonable or not? Am I okay with that or not? So in that spreadsheet, what variables can we modify? And I won't play with it here for the sake of time, but you know, a lot of us think, you know, oh, if I can save 50 cents per pot, you know, per box of pots, you know, I'm getting a good deal, right? And so we tend to we beat up our vendors to get nice and low prices, and which is all well and good. We should keep our pricing, the pricing that we're paying, as tight as possible. But if you go back to the previous slide and start actually manipulating some of those things, we see that the effect that manipulating direct cost has on our net profit margin is so much lower than the effects that we have of increasing our price, right? So like a 5% savings in costs has much, much lower impact on our net margin than a 5% increase in price will have. And you can use that spreadsheet and start manipulating those numbers to see, could I squeeze, instead of $5 on that geranium, could I get $5.25 for it? And then we ask the questions of how does that stack up to the industry? How does that stack up to the market around me, and questions like that. You know, maybe I need to grow fewer of that geranium, but I can grow more of a petunia or something like that. And then I want to just quickly ask, what is our competition, right? So is this our competition? Is our competition the person down the street selling the same stuff that we're selling? I mean, obviously, that's the obvious one. If we could poach a customer who's walking in with money in her hand because she wants to buy a flower, that's the easiest customer, of course, to grab, and the easiest competition to take on. But I would just kind of, and I know we already know this, but and COVID kind of accentuated this reality for us. We've been saying this for a while, that our competition actually is all the other stuff that competes with the consumer's desire to beautify their space with the plants that we have to sell, right? So, you know, if someone's a couch potato and they start growing plants instead, we've competed with the television, and we're extracting money from this person, whatever the person's hobbies are. And we saw that in COVID, where, you know, some of the best years ever for the greenhouse and ornamentals industry were because people weren't taking vacations, people weren't paying for travel, etc., and they were paying to improve and beautify the space that they were living in. So I just encourage us to think beyond simply undercutting the price of the person down the street who's selling flowers, and think about how can we get some of these harder customers. It's harder to steal the customer away from these other endeavors, but there may be a greater return in that.